Hi, I'm Kate Jordan from Bell Direct and welcome to our new series of interviews focusing on small cap companies. Joining me today is Karl Siegling, Managing Director and Portfolio Manager at Cadence Capital, a boutique funds management firm that focuses on both technical and fundamental research. So to start off with, Karl, I just wanted to ask you a little bit more about your investment philosophy and what are some of the events in your life that might have shaped this?
Yeah, I think, look, what's unusual in our business is you would have heard 100 people say we're fundamental analysts, that we like to buy low and sell high, or we like to buy cheap companies and sell expensive companies. I suppose my response to that would be, isn't everyone trying to do that? And I would presume that people are buying companies that are cheap and trying to sell companies that are expensive. But there's something else taking place in the market all the time, which is timing, when to buy something and when to sell something. And really that's how we come up with our philosophy, that you need both fundamentals and technicals in order to make an investment. So a fundamental person would say you only need fundamentals. We'd say no, you also need technicals.
Fantastic, yeah. So I think that's quite relevant to our traders who are very keen to learn a bit more about the technical aspect to it. When you talk about timing, do you use a particular indicator?
Yeah, I'd say now let's migrate the story slightly. So I was trading currencies and people use a lot of sophisticated trend analysis and very, very detailed trending tools and programs to trade currencies, because really you're very dependent on technicals. Now let's flip it over to equities. Equities in the end do trade on fundamentals. So if something is genuinely cheap, it will start to go up in price until it's what people deem fair value, and then it'll go beyond fair value, then it'll get slightly expensive, and then something can get very expensive. And so the technicals required to invest in equities are actually, in our view, a lot easier than the technicals required for some of those other marketplaces. And they really depend, in our case, on a 3-month trend, a 1-year trend, and a 5-year trend. And what they do is they're there to ensure that your fundamental work is right.
So you're really using this to back up the fundamental analysis?
Exactly. So you'd say we're coming from a strong fundamental position, and then we have to work out whether the technicals are consistent with our strong fundamental view. So let's take an example. You're going along, iron ore is $20 a ton. It starts to go up and up and up and up, 40, 60, 80, 100, 120, 140, $160 a ton. And companies that produce iron ore, their share price is just going through the roof. And that kind of makes sense because the iron ore price is going up, they're making more and more and more profit. Then the iron ore price rolls over and starts to go down. No analysts put that into their forecasts because they weren't prepared to put $100, $120, $140, $160 on the way up. But once they've got there, they certainly don't want to put 20 back in their models again. So the fundamentals really lag what's happening in the marketplace. So people are reluctant to put the actual changing commodity prices in. And then eventually iron ore prices start to fall. 160, 140, 120, 180, 60, 40, until we get to the stage now where everyone goes, oh no, they'll just go back up. And all the way down, everyone was just saying they'll go back up, they'll go back up, they'll go back up. But technicals have shown you that when the fundamental story is over and the stock's rolled over, it's all over. So that's why we've been so compelled to say, since the resources bust several years ago, that the trend is just down. And the fundamentals will catch up with that story. And the fundamentals will be that the spot iron ore price will be about what it costs to get iron ore out of the ground, and those companies will make no money.
So this trend following strategy is quite interesting, which I guess leads me to my next question. What happens when it goes all pear-shaped? I know we all struggle to cut our losses early. Are there any particular indicators that you use?
So let's just broadly outline how things go pear-shaped. Things can go pear-shaped because they can get way too cheap fundamentally, or they can get way too expensive fundamentally. And that happens. So fundamental investors struggle with that concept. They're like, okay, this is too cheap but it keeps falling, or this is too expensive and it keeps going up. Then the other way things go pear-shaped is that, as we described before, the fundamentals are lagging a long way behind what's actually happening. So your fundamental story is telling you something, but that story's ended. For example, Kodak was very cheap just before it went bankrupt. That's because Kodak film was just about to go to the wall and everyone was using digital cameras. Nonetheless, the stock looked very cheap. Yeah? So what tends to happen is you need to look at those things, and this is really quite difficult for people to, the two sides of your brain need to be operating at once, which is, this looks fundamentally cheap, but it keeps falling. Don't touch it. Right? Or something looks fundamentally expensive, but it keeps going up. Don't sell it. Something looks fundamentally cheap, but it's rolled over, like the resources boom and bust, looks fundamentally cheap, but it's rolled over and starts to fall, sell a third, sell a third, sell a third on the way down. And so no one rang the bell. You always hear the saying or read it in books, no one rings the bell at the end of a boom. So the first you know about it is the boom's over. In fact, the first that we got told about it with some authority in Australia that the resource boom was over was a government think tank 3 years after the resource bust said, we think the resource boom's over. Now that doesn't help you as an investor, right? Because all the share prices have gone down to 1/3 of what they were. So that rolling process is very important for scaling out of positions. And in our case, that's how we scale into positions as well. We never take much risk. It's a 1% position at cost. Then we add to it on the way up.
So now I'm really interested to hear, what's your best investment of the year? I know, Blackmores has been up 96.5%.
So let's start with Blackmores. I saw Blackmores about a year ago, and I've been following Blackmores and Suisse for many, many years. And Blackmores had just been going, it hadn't moved really, the share price, for many years. And management said, look, we think that there's indications that the price war between Suisse and Blackmores has ended. And and as a result of that, profitability is going to improve. Now, it seemed to me that was so obvious and plain that I thought, I was a bit suspect. I thought, is this really right? And I didn't actually buy any. So now you want to talk about opportunity cost. That was at $29. The stock's now, what, $129? And I just simply didn't, that really was for us quite a big mistake not adding to, and we would have added a 1% position, then kept adding to it and kept adding to it. And of course, now we know the story. The Chinese tourists are coming over, they're filling up barrel loads of, or suitcases full of vitamins and going back overseas with that. And the war has ended, the price war with Suisse has ended, and so they're really in a very sweet spot, Blackmores.
Okay, I'm going to put you on the spot for the last question. What would be your favourite stock for right now?
Gee, that's difficult at the moment because the market has run very hard. I still think we've spoken about Macquarie. I think Macquarie is still going quite a bit higher. They're about to break $2 billion of earnings per annum, and that will get a PE re-rating. So I think if people put Macquarie into their portfolio over time, you'll make money. And also, particularly because we've just had this Chinese judder, that now's probably a good time to buy some Macquarie. We like Melbourne IT. We finally think on the small side that Melbourne IT is about to turn around. And Melbourne IT is cheap. It's unusual to find a cheap stock in the marketplace at the moment. We think Melbourne IT is cheap. There's, 3 examples of things that I feel are going to go pretty well.
Fantastic. Thank you. So that was Karl Siegling of Cadence Capital. If you have any suggestions of companies that you'd like to hear more about, please email our client support services team at support@belldirect.com.au. Thank you, and we'll see you next time.